Now that the Fed has put in place the commitment to keep rates super low through the middle of 2013, do you continue to dissent with that policy, or is it a one and done deal and then you move on?
First of all, it's not a commitment.
Okay. A promise?
It's an expectation.
Okay.
And that's the way it's stated in the statement. One of my concerns was that it would be interpreted as a commitment. You just used the word commitment. I think it has been interpreted as a commitment, but I think you have to be very careful to parse the words of that statement. It is actually not a commitment. It's an expectation by the majority of the committee. And here's an example of how we deal. The question is, how do we state what we want to do? My interpretation of that is it would be interpreted or might be interpreted as a commitment at the marketplace. And I didn't think that was the right signal to send. It's just a personal opinion, and so I voted against it. In addition, one of the things that I was concerned about is we had some volatility just before the meeting. Equity markets were off a little bit. The spreads have been widening a little bit in the bond markets, particularly on triple Bs and others. That this might be viewed as, our being eager to put in place what I call a Bernanke put. So I don't believe it's the business of the Fed to have short-term reactions. But this is, again, just my interpretation. The others had their explanation in the minutes, as you saw. And every time we meet, we look at what we might consider doing, and again, ask the question, is it practicable? Will it have the effect that's intended? But one thing Chairman Bernanke made very clear in Jackson Hole and again in Minnesota, and I have spoken about for years, literally for 3 years, we can't do this alone. Everybody's looking to the central bank to do everything. It doesn't work that way. If we don't have fiscal discipline and the right balance between goosing up the economy short term and solving our long-term problems, then all of our work is for naught. We can't carry this load, and no central bank should attempt to do it. It creates enormous moral hazard. And I'm going to speak about that today at 3 o'clock.
But even with the paralysis we're seeing out of Washington, don't you feel an obligation as a central bank to do something?
I feel an obligation to do what's right for the country. We all do. And sometimes if we just try to if we were to be the only active agent, we might do more damage than good. The good now, we have done a good job. We reliquefied the economy. The cost of money is not an issue anymore. The availability of credit is an issue for small businesses to a degree, but if you look at their surveys, that's not their primary concern. What's inhibiting them from hiring the women and men that we want to put back to work? Uncertainty. Where does that uncertainty come from? Well, part of it's not being certain about final demand. The European situation makes that a little bit more complicated, obviously. Tremendous uncertainty stems from they don't know how they're going to be taxed. They don't know what the regulatory side is going to be. What happened during the debt negotiations, they threw everything up in the air. The president made a speech. It's the beginning of a dialogue. I'm glad they're going at it with each other, the Congress and the president. We need answers. And if you, as a young woman running a growing business, let's say you had 35, 40 employees, that's where jobs are created. You don't know what's going to come at you. What is your tax rate going to be? How much is healthcare going to cost you? What other regulatory initiatives might be changed or improved? Where is government spending going to take place, and will it impact you? Can you sell into it or should you circumnavigate around it, et cetera? That, to me, is what needs clarity right now, not just monetary policy. Monetary policy has been extremely effective in refloating the economy. To move that ship forward, you've got to have fiscal policy, and if we just become the agent of doing everything, it takes them off the hook. I think that's a mistake.
So Fed should stop doing extra.
The Fed should be very, very careful not to overplay its hand.
What about this Operation Twist, pushing down yields on long-term maturities?
I'll refer to it this afternoon, so I'm glad you're staying for my speech.
I will be staying for your speech, but it seems to me...
You have to remember the 10-year bond is at 192 as we speak.
What does that mean?
That means that we have very low intermediate term rates going way out the yield curve. We're from 0 to less than, and we have inflation. Let's say we're right at the Dallas Fed, and inflation is going to come down to 2% rather than the headline rate we've been seeing recently. That the chairman and the rest of us have been saying there's some temporary factors at work. We still have negative yields. Part of that is out of our control. There's a rush to quality. So that those that have fear elsewhere in the marketplace are flooding into our treasuries despite what Standard & Poor's said about us. And the question is, how effective would an Operation Twist be? needs to be looked at. It's one of the possible options. How far can you drive rates down? What else is working in the marketplace? What effect will it have? These are the kind of discussions we need to have.
Here's one merit that I would think of Operation Twist, and that would be confidence. Business confidence, investor confidence, household confidence. That is what is lacking right now. And with a move like that, perhaps it would inspire investors to invest in riskier assets. I know that's something that you're not 100% on, but that is what we need. And that's something that Operation Twist would help to stimulate.
That's an interesting viewpoint.
That you don't agree with.
I'm not saying I don't agree with it. There are offsets to that. And we'll just have to see what the arguments are and how persuasive they are on both sides of the equation if this is indeed debated at the next meeting.
Do you think you're more optimistic than the Fed chairman on the outlook for the economy right now?
I'm going to talk about that this afternoon too. After every financial crisis, and you and I, before we went on camera, were talking about Japan. I lived in Japan through that crisis. After every financial crisis, it takes an enormous amount of time to recover. And I'm going to show some numbers and some charts this afternoon. Question, how do you change that tempo? Ken Rogoff and others have done enormous work. Our own Mark Wynn at the Federal Reserve Bank of Dallas has done a significant amount of work on this subject matter. Can you change the slope of that curve after you've had a gap down and then very slow growth going out for many, many years? Or can you make it worse by your activity? And this is, again, a trade-off that one has to consider. We do know this. It takes a long time to recover from a recession that is financially induced by financial panic and a financial problem, a banker's problem.
A balance sheet.
Well, the fact is that this stems from a financial crisis. How much can you change the tempo of recovery? What risks do you entail in trying to change it? Where can you be most effective? And again, I go back to this business. Hawk and dove doesn't mean a thing to me. Mm-hmm. The real question is, what is the most effective? My perspective is different than my colleagues. I do not have a PhD in economics. I am proud of that because I came up through the markets. I'm the only one on the FOMC that ever ran a hedge fund. I'm the one of 3 that was ever a banker. So I look at it from a marketplace perspective.
And what's the biggest difference in your view than your colleagues, the PhD economists?
Well, I think it's a good balance because they have great theoretical backgrounds. Now, I was trained by Robert Rosa, and I've had the privilege of working for great minds, and including with Ben Bernanke and others. But I tend to look at things from a microeconomic standpoint. How is this going to affect business decision making? Private businesses create jobs. Small and medium businesses are the ones that are the incubators of jobs in our country. It's the way we work. So I tend to look at that perspective and what kind of incentive it will provide there. So it's not that there are abject differences, it's just that we bring a different perspective. That's very, very healthy. Elizabeth Duke, for example, one of our governors, built small banks, sold them, became head of the American Bankers Association. She understands how bankers think. That's a good perspective to bring to the table. So we bring different perspectives to the table, and you certainly don't want everybody to think alike or to have taken the same economics course or get the same PhD material. Everybody should have a different perspective, and I think it's a great balance that we have.
You mentioned Japan, and you're the expert. We
I'm
are not
an
Japan.
expert.
You are an expert.
Okay.
The U.S. is not looking like Japan, even though
No.
our bond yields are near record lows. We're having this long period of sluggish growth. I mean, these are some of the parallels that are being drawn.
Well, again, go back to Rogoff and Reinhardt's work and others. That was a financially induced crisis. I lived and worked in Japan. I ran my fund out of Japan. And I should say, incidentally, I learned more. My son played on a Japanese baseball team. That's where you really learn the culture. Okay. They did not reform their banking system until very late. They still have these mega institutions. You take public servants, give them the golden parachutes, put them in these large institutions. Therein is the lesson. And we have to treat too big to fail, which we're still working on. We have to deal with our banking system. That is the transmission mechanism out in the financial system for monetary policy. Unless you have a good transmission system, then all the work we do on monetary policy is for naught. Or put it this way, it's diminished by that factor. And I think that was Japan's biggest mistake. That's one point. Second point, we are not Japanese. We have a different type of dynamism in our society. I've lived, I've worked there, I've been everywhere in that country. And America's a different kind of place. So I don't like using the two as we're falling into the Japanese trap. The trap, if we're in a trap, is what happens after all financial crises, whether they are in Japan or any other country. And I'm going to refer to that a little bit this afternoon.
Wow, you've
I keep
got
teasing
a lot
the
of
speech,
ground
you
to
know.
cover in
Yeah.
this.
Well, it's a short, concise, incredibly articulate speech.
Back to, we were talking about currency devaluation.
And I'm going to talk about Texas at the same time.
Oh, and the Texas economy. I know that's
Yeah,
been one of the subjects. I want to ask you about currency devaluations because we recently heard from Brazil's finance minister. He said we're back on QE3 if the Fed implements, or we're back in the currency war if the Fed implements QE3. Is this something that you're aware of, concerned at all about?
Other things are moving the market right now. We're at just under 137 on the euro. That's happened very quickly. We dropped from 144 on the euro to 137, or we rose, if you take the counterpart. That's not being driven by any expectation of a change in monetary policy or what the Fed's going to do at our next two-day meeting. That's a flight to quality, and it's being driven by the occurrences in Europe presently and some of the sell-offs that are occurring in other places. It is heartening that we are where everybody rushes into in the end. And all this discussion about the end of the dollar and the end of the United States and the Chinese renminbi superseding America, markets vote with where electrons go, and they're gravitating towards the United States. It's helping our country and certainly helping our government from the standpoint of driving yields down for the U.S. Treasury. The cost of money for the Treasury is less, and it's strengthening our currency, which can have a negative impact too in terms of our export activity, but at the same time might send a signal that the United States is still where everybody wants to be, and this is where capital should flow.
There's not a confidence problem with the United States and the dollar and treasuries.
Remember, it's relative to what? And now, I've said this before.
Best in a bad neighborhood?
Well, I don't want to be the prettiest horse in the glue factory, okay? We have to deal with our own problems. If we deal with our own problems, then I think we will unquestionably not only be a relative preference, but an absolute preference. I don't think you can fault monetary policy here in terms of we may have had disagreements as to how to do things, but we basically got it right. Now we have to get fiscal policy right, and that's not up to me, or I'm not an elected official. It's up to the people we elect to tax and spend us.
But if you want, if one policy, if Congress could get their act together for one policy right now, what would you like to see?
I'd like to see them get their act together.
And do what?
That'd be a good beginning.
And do
It's
what?
up to them. That's what we elect these people for, and they're our fiscal leaders. So it's between the president and the Congress. They're hammering it out. That's good. This is a good discussion. We should have had it years and years ago. But it's happening now, and we'll just hope it obtains.
And lastly, did you tell Rick Perry to stop bashing your boss?
I don't talk to the governor. I don't know him very well. I think instead of treason, what I think he meant was reason. He just added an extra letter.
That's a good defense for your guy. Okay, thank you very much.